Good afternoon and welcome to the BRAEMAR PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO James Gundy. Good afternoon to you.
Good afternoon, thank you. Welcome to BRAEMAR's FY25 results presentation. My name is James Gundy, the CEO. I'm with Grant Foley, our CFO and CEO. So congratulations, Grant. Just an introduction about myself. I'm sure some of you don't know who I am. I'll just mention the fact that I've been in the shipbroking space for some 40 years, starting my early years, first 10 years at Clarkson's, then moved into a company called ACM. We successfully IPO'd that company in 2006, where I eventually become the CEO of that business. We merged in 2014 with BRAEMAR. I became the CEO of shipbroking, dropped off the board, put what you could say a difficult merge together. Then in 21, I became the CEO of BRAEMAR PLC, and we will go through the slides and sort of explain a little bit about what we've done in that period and where we are today and where we're going forward. So thank you. So just to start on the first slide, I think the most important factor for me was that coming into BRAEMAR as the CEO was to make sure we built a business that was robust and financial performance. So as far as robust and obviously creating resilience. We have implemented all that strategy in the last 4 years. We believe that we can deliver now further growth as the business moves forward. The financials are strong. BRAEMAR balance sheet is in a good position. Tight control costs. Grant's doing a superb job there. The strategy, we relaunched a 5-year strategy, which we're going to framework, which we're going to explain to you later down within the presentation. And yes, there's been some opportunities, some short-term headwinds within the business, but the long-term opportunities still look very favourable from where we are. Now, this is just to show you a little bit from when I came in January 21. I think you can see from the bottom there, it says the revenues are up some 70%. The underlying operating profit is up 88%. This is mainly created by a diversification story and moving away from non-core businesses, which we were involved in before. So it allows us less distraction and focus on a diversification story within the shipbroking space. Anything necessarily complements the business. Just on the right-hand side, you can see we've got some 411 people within the business, some 18 offices across the globe, in 13 different countries. And I'll pass you across to Grant to give you a bit of the financial performance of the business.
Thank you, James. So just starting with the financial highlights, the group has delivered a solid financial performance for FY25 with revenue of £141.9 million. Whilst the first half performance showed an improvement on the previous year, the second half was significantly weaker, and that was really driven by lower tanker performance, and we'll talk a bit more about that shortly. But this was partially offset by a stronger performance from our investment advisory division, which really reflects the increasing resilience that we've built into the business over recent years. Underlying profit before tax and excluding an acquisition-related items was £16.7 million, which was £1.4 million lower than the prior year, really reflecting the weaker revenue performance and subsequently lower bonus costs. However, as a result of the continued tight control on costs, we are pleased to be able to maintain our margin at 12%. At the year end, the group had a net debt position of £2.5 million, and that was due to some adverse temporary working capital movements, which was primarily lower than expected cash receipts in January and February. That subsequently caught itself up in March, and we swiftly returned to a cash positive position in the first couple of weeks of March, which is typical of our working capital cycle. We have a strong forward order book. So our forward order book is where we have vessels either for sale in future periods or new builds and time charters. and we maintain that strong forward order book position at $82.2 million. And we announced today our new capital allocation framework, which I'll give more detail on later. So we've taken the decision to reduce our final dividend to 2.5 pence, but we've announced a share buyback programme of up to £2 million. So ultimately, we've ensured that total shareholder returns have been maintained. So if we just move on to the income statement, revenues decreased by 7%. And as I've mentioned, that was really our chartering business segment where it was impacted by significantly weaker tanker and dry cargo rates in the second half, although offset by investment advisory slightly, which was 18% up. That was really a strong performance for our sales and purchase team. Risk advisory was down slightly, 3%, but underlying operating profit before expenditure-related expenditure was down 7%, with margins maintained at 12%. Our statutory profit at £9.2 million was 23% higher than the previous year, and that was reflecting lower specific costs that we had in the FY24 numbers. So we've focused over recent years on diversifying within shipbroking and securities and building resilience into the business to give that resilience across the shipping cycle. Chartering revenues, I've said, were down 14%, with £14.5 million due to tanker revenues. And specialised and dry were also down. But we had a very, very strong performance from our offshore desk. That was up £1 million to £9 million. I've said these lower chartering revenues were partially offset by a strong performance in investment advisory, which in total was up 18%. And within that, our sale and purchase desk was up 19%. And that performed very strongly in both new builds and second-hand. Risk advisory, as I said, broadly unchanged. But this month, we received permissions from the FCA to operate a UK organised trading facility, which is a venue which allows our securities business to trade additional products. And we believe that we're going to see that division return to growth this year on the back of that. Moving on to operating costs, we continue to maintain a tight control of costs, but we are balancing this with a focus on efficiency and investment. Ultimately, lower revenues led to lower bonus costs during the year, with staff costs reducing by £10.9 million. Professional fees increased, and this was partially due to the proactive investment that we've made in establishing the UK organised trading facility to drive further growth in our risk advisory division. And finally, other costs of £1.1 million reflect an increase in bad debts and the investments made in our IT uplift programme to improve our data capabilities and drive further efficiencies across the business. So our liquidity position remains good. We had a net debt position at the year end, although, as I said, we returned to cash positive shortly after, in line with our working capital cycle. If you look at the waterfall on the left, you can see where the cash went during the year. From our starting position of 28 million, we generated £21 million from underlying operations. Working capital movements were a reduction of £10 million. Financing and tax was £3 million outflow, and we paid £5 million in dividends. We continued to purchase shares for our employee share ownership plan, and we reduced our total debt by £8 million as we focused on the efficient use of our cash. So finally, if we look at the group KPIs, unfortunately, given the strong first half performance, we did not see the step forward we would have liked to on the prior year, given the more challenging markets that we saw in the second half of the year. But I do think it's encouraging to see the significant growth and resilience that we've built into the business if we look back to FY21. And in FY21, that's the last time that we set ourselves some medium-term targets, which was to double our underlying profit by FY25. So whilst revenue was down 7% in the year to £142 million, it was 70% higher than FY21. Revenue per head, 8% lower due to lower revenues, although it continues to be very strong by industry standards at £345,000, 46% higher than FY21, And it's worth remembering this metric is actually based on all staff, not just revenue earners. Operating profit margin maintained at 12%, which is a 3% improvement from FY21. And our focus on efficiencies and increased productivity will improve this going forward. Our forward order book continues to be strong, as I've mentioned, at $82.2 million. I've talked about net cash, and finally dividends, 2.5 pence, final dividend of 7 pence for the full year, with a share buyback program launched today of up to £2 million, maintaining shareholder returns. And just coming back to our target, we set our FY21 target of doubling underlying profit. It's worth remembering that was achieved in FY23 and FY24, and in FY25 we did have that strong first half performance, but then we did see an impact from the rates in the second half. I'll now hand back to James to go through the strategic update in more depth.
Thank you, Grant. So I think what we're trying to sort of show here in the first slide is basically we haven't seen a fall in the second half rates or market or numbers since 21. That was obviously being in the COVID situation. So normally in the business with the second half of the year, a higher performance in revenue. That obviously changed this year, which is unsurprising to ourselves and to many. There's obviously a lot of factors and reason for that. A lot to do with what's going on potentially in the US at the moment, pre-Trump coming to administration. The tanker rate index on the right-hand side is showing you the fact that the market has been exceptionally strong in some parts in 22, 23. We saw it dip down, but then since then we started to see the markets move back up again. So we're feeling that the markets going forward for this year are increasing. So it's better for the business there. Now, most of our business is based in US dollars revenue. There may be some 5% is in other currencies like euros or sterling. But you can see that has impacted the numbers in the second half as well, because we've seen dollar sterling move to 135 as opposed to where it was in the year earlier. The BRAEMAR index gives you an all-ship index of where we are in the cycle. Compared to where you were some 10 years ago, the cycle is still far higher. And the outlook, we're still very confident in the outlook for many reasons. I think you'll see in the slides coming forward. I can explain it from there. So, on the first slide is a global fleet, and that's basically everything you'll see from gas carriers to LNG to containers, dry tankers, and other various sectors as well. So, you see the global fleet has grown. In all essence, that's obviously a positive for us as well, because that means more transactions. BRAEMAR is in every sector there is out there on that global fleet. On the second slide, it's showing you the fact that the fleet is aging, which needs to be replenished. Normally, we would say max 15 years of age, when would be the cycle life of a ship. So that's sort of moving towards 20-year cycle. But the fact is, the fleet needs to be rebuilt, and you can see from there on the new building program that's starting to increase. BRAEMAR is increasing. There's obviously bigger than new building sectors, a large part of our new building, of our revenue stream and our forward order book. Looking further ahead, we've taken some graphs from data. The oil demand is still increasing. You can see that drive going through there. We can't necessarily dictate how that flow will go because of so many implications in the world today. But the fact is, demand is increasing. Now, as far as China, we had a little bit of surprise there during COVID. We thought that we would see a bit more of after COVID, we'd see a bit more of a return to China. That's been a bit slower, but we can see that the output growth going forward is starting to go. And China is obviously a huge part of the shipping business for demand. And the global GDP is obviously, you can see the curve there going forward as well. So it's obviously good for shipping. Shipping is a huge, indicator of the global GDP. Now, today we sort of came out with a new strategic framework, and we want to build some momentum. When I came in 21, I mentioned earlier that building a diversified business that was able to protect itself or slightly become very immune from any one sector coming through. from my previous CEO was at ACM. That was a little bit one-dimensional, so it's important to get to a business that's more diversified and stick to shipbroking. So that's one thing we have done within the last 4 years. I'm a great believer in consolidation. And I can explain that the fact that as the business moves more towards a compliant world, that's giving us opportunities to pick up the smaller businesses that are having to sort of look at the idea of having to make them more compliant or move into a bigger shop. So that's obviously happening. And at the same time, we've probably moved away from some of these consolidations recently in businesses because the time frame wasn't ready. But now we feel by building a strategic framework, it's the right time for us. Operational excellence, Grant's put that lots of it in place, has really built a proper framework for us to build in our business. That's all in place, so it'd be easier to drop those businesses into the company. Now, we've obviously put ourselves a target here of 200 million as far as sterling, as far as by FY30, as far as our revenue. Risk advisory business revenue up by 21 now to 30 million. The underlying operating profit margin for FY30 by 15%, and obviously you see a 1.5 EBITDA. So now, obviously on top of those targets, we're sort of putting ourselves at 10 new brokers as hires. And then we're talking quality brokers, proper brokers, and 1 new area of jurisdiction, globalized tanker operations. We can stay a bit more on that afterwards, and 1 complete complementary transaction within a month.
Thank you. So just picking up on those 3 pillars, we have already made good progress in a number of areas within this framework, given the strategy that we've had in place over recent years. And just picking up our risk advisory, which is a great example of the success that we've had in diversifying our revenue streams. This segment has been steadily building. In FY21, we had £7.5 million of revenue. That's increased to £22.3 million in FY25. These operations comprise of tanker and dry cargo forward freight agreements, which allow our clients to hedge their freight positions, coal, natural gas and oil, so highly complementary to the shipping industry. Importantly, we do not take risk in this business. We provide agency broking services, so there is no balance sheet risk that we take within this division. In FY26, at the start of this year, I'm pleased to announce, as I said, that we've secured our organised trading facility approval, and that's live, and we're already seeing some of our clients trade on that venue. It will allow us to trade additional products as we bring more brokers and opportunities on board. And we're also some way through the application to establish a European OTF, which will be based in Spain under the CNMV, who are the regulator out there, to trade with more European clients. So we're quite excited about the opportunities here. And if we look at consolidation, whilst we haven't completed a transaction this year, we looked at a number of deals during the course of the year, but we have maintained our discipline and we've focused on shareholder value and deals that would complement our existing business, the BRAEMAR business, as well as the business that we would be acquiring, which is what we've done in the deals that we've done historically. Now, what you can see here, we've used this slide before, but the white space shows how many opportunities there are out there. So whilst we have some short-term headwinds that James talked about in terms of FX and rates, we believe that this market does present us with significant opportunities at the moment, as the valuations for those businesses are coming down. There was probably, it's fair to say, a disconnect between public and private valuations when we've looked at transactions in the past. We see that becoming closer, and we're well positioned to take advantage of that. So as you can see, that there are lots of opportunities, not only by desk type, but also by geography, that we can take advantage of. And finally, operational excellence is really the focus on building efficiencies in the business and adding value to the business. So as we continue to invest in our platform, and what we mean by that is our platform to support a growing business. So we have built the finance, the compliance, the IT infrastructure that can support a growing business. that will support our growth. And if we look at it from an IT perspective, during FY25, we improved our infrastructure, we modernised it, we went cloud first, and we unified our global technology stack. We've had a focus on productivity with real-time data feeds and tools that will enhance the broker productivity. And we've also had a big focus on performance improvement. So we've invested in business intelligence tools to give us a much deeper and faster insight into business performance. While we're looking at processes, and we've automated workflows, we're aligning global processes to really drive the efficiencies in the business. So when we look at our FY30 target of 15% operating margin, that's about ensuring that we've got the support functions ready to support the business. And as we bring those additional revenues in through organic and inorganic growth, we can drive that margin forward on that. And then to finish for me on the capital allocation policy. So we've amended our capital allocation policy today in support of our strategic framework that James outlined. And we would feel that this reflects a balance between growth investment and returning cash to shareholders. So first of all, we will maintain a robust balance sheet with net debt of less than 1.5 times EBITDA. Secondly, we will continue to invest in talent to grow the business, but we will maintain our discipline to ensure that those generate shareholder value and focus on driving efficiencies and improved margins. We will not participate in paying lots and lots of money for hires if they are not going to generate returns and shareholder value. Thirdly, we will continue to look for acquisitions that allow the group to accelerate its growth, but they have to meet our strict value enhancing criteria. And finally, we will return excess capital to shareholders through dividends and share buybacks as we continue to grow the business.
Thank you. So, summary and outlook. I think we could first say it's a robust financial performance, clearly illustrating the importance of diversification, something I very much was clear when I came in 4 years ago, which enables to build resilience in the business. The underlying operating profit margin maintained at 12%. Return to net cash position shortly after year end, in line with the usual working capital cycle. Total dividend 7p, £2 million share buyback announced, total shareholder returns maintained. Outlook. Yes, some short-term headwinds driven by ongoing uncertainty and weak US dollars. Affecting this expects FY26 underlying operating profit to be now 13 to 14 million. Strong forward order book, maintained 82.2 million. Strategic framework launched with short-term and medium-term targets. Market fundamentals remain strong. We continue to be well placed to take advantage of opportunities ahead. Thank you.
Fantastic. James, Grant, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to read those questions submitted today, I would like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via Investor Dashboard. And James, Grant, as you can see, we have received a number of questions throughout today's presentation. And if I may now hand back to you and kindly ask you to read out the questions where appropriate to do so, and I'll pick up from you both at the end. Thank you.
Thank you very much. I'll read the questions. Thank you. First question is, will you be looking at further acquisitions or other M&A?
Look, I think we want to sit here first of all and say that we sort of touch base on the fact that we've been patient. There's been quite a few M&A deals come past over our desks and bows, to say. But the fact is, it's important to make sure we do the right thing that's enhancing for the business. And for someone who's been in the business for some 40 years and seen many markets move up and down, it's important to make sure we get that at the right valuation and it's integrates the business and enhances the business as well. So yes, there is opportunities out there, and yes, there's a good chance that we will do that. We've also outlined the fact that we'll do singular hires, potential desk purchases, or potential bigger M&A deals.
Yeah, we certainly believe that, given that we're seeing a slightly softer market, there's going to be lots of opportunities for us in that space.
And I think I want to just emphasise on that question as well. I think we did touch base as well that, you know, we built that platform. The business is becoming closer and closer to, you know, to a regulated business. Not that it's not necessarily there yet, but compliance. This is all a cost factor for smaller businesses, and I think that for them, as the clients demand more of this, that it gives us the opportunities to pick up as they start to think this is the right time to move out of that business.
Okay, thank you. Next question. Please could you explain what is your future dividend policy, given that you've now cut the final dividend to 27.7% of last year's final dividend of 9p to 2.5p? Would it be a fair assumption that you intend to cut the interim dividend by a similar amount, reflecting it to 1.25 pence from 4.5 pence, given that you normally pay 1/3 of the interim dividend and 2/3 as a final dividend? So I think I'll take that initially. So just as we think about our capital allocation framework, which I just outlined, we do feel that we are faced with a number of opportunities which will generate long-term shareholder value, and that's why we've laid out that clear capital allocation policy. But of course, we do want to continue to pay an attractive dividend, but we have reduced it. But although we have maintained total shareholder returns, I think it's fair to say that the dividend will remain, will remain a dividend-paying business. 7 pence for the full year this year. Reasonable to think that will hold at that level. Now, how that cuts between interim and final is up for debate. We haven't thought about that, so it could be 1/3, 2/3, but we haven't fully decided on that yet. Next question. New building had a good FY25, but you comment that uncertainties around tariffs and US port calls caused many clients to pause investment projects. Would reduced tariffs and fees on US port calls be enough for new building orders to recover, or does it need their removal and certainty that they will not be reinstated?
I think from my perspective, I think, look, it's a tall ask to start to sort of move into a situation where you're going to labour huge tariffs on a Chinese-built ship. I potentially see the fact that it could be potentially targeting certain companies. You know, there's even conversations about Chinese financing as well being attacked, so tariffed as well. So if we're just seeing that, but from my talking to the various client base, it doesn't feel yet that it hasn't slowed down necessarily orders in China as they see that. We're seeing orders still being placed within China, obviously Korea and Japan as well. But at the same time, we're moving into other parts of the business where we're seeing that the alternative fuels, whether that be dual fuel as an LNG or methanol or ammonia. So there's that pressure as well to build ships. And, China has been the large area of building ships. So it's difficult to see which way that will go. But the fact is, look, we're well placed in that position of those markets, but at the same time, the appetite hasn't totally dwindled on those as what you call the Chinese-built ships.
I'd add to that as well. So that we showed that chart earlier, which showed new building orders. Over 20% of capacity came out of the new building yards post the GFC. So the yards are pretty busy at the moment. There isn't a lot of available slots, and that chart just to the left of that showed an aging fleet. So these vessels are going to have to be replaced, and so we're going to continue to see reasonable new building activity. Next question. You referenced expanding teams. How are you finding recruitment in what is likely to be a competitive talent market?
Yeah, I think I can answer that question. Look, the market has been, as I say, the last 3 or 4 years, it's exceptionally competitive, and we've obviously, Grant is very much looking at. We both look to make sure that we see a return of those talents as how we structure that as far as what we would call sign-ons, and making sure that we see a return on that investment. And we've been shy to get into some form of bidding war, because sadly, I've seen rates go down as well as go up, and we feel been very toppy in the market. But at the same time, it's important to sort of promote Braemar as a company that is on multiple different markets. It does help a broker to have that information to obviously supply to their clients. So,
You talked about the cost, next question, you talked about the cost of talent reaching uneconomic levels. Can you say what parts of the market this was and what sort of organisation was paying these uneconomic levels?
I mean, I think you can go through that.
Look, we saw competitors and heard of competitors paying quite significant amounts of money for individuals to join their business, and our view was that they were just uneconomic. This was at a time when, yes, rates were stronger, but as James has already said, rates go down as well as up. And when we looked at it, it was that you look at those numbers and you're looking at a significant period of time before you get a payback on your investment. And that was at a time when rates were strong. As we've seen with weaker rates, you're going to have a significantly longer period. And so our focus during that period was not to participate in that bidding war, as it was, but to focus on retention, which we've done during that period. We now think that there's being a more normalisation in that space. And again, it comes back to the opportunity that we see, just short-term headwinds, but we feel it's an opportunity to acquire talented individuals as well.
And it's very important that, that when bringing new talent into the company, you're careful of not literally going too far the other way and overpaying. As Grant mentioned, this doesn't become uneconomical sense to do that. But the fact is, you've also got a large team within the business, and that also can create a rocking wave if it doesn't work out too well. So you have to be very careful of what you do, because it can upset internally as well.
Thank you. Next question. What is your take on the China-US trade patterns for shipping? Any desk insight?
I mean, I think obviously with the tariff, it's still not totally clear on what's going to happen with the Trump administration, because as you can see, I'm sure you're all very aware, that is moving around a lot. It has created some uncertainty, as we have mentioned a moment before. But, obviously the US is an exporter of oil, as they're obviously huge as far as taking in from China, as far as on the container market as well. So, look, we just feel that it's going to be interesting times. It also adds into the fact that what's economically making sense, moving oil around, and what the trade patterns are going to be. So at the moment, it's creating a bit of uncertainty, which potentially goes back to where we feel it gives us opportunity.
Next question. What will cause your margin to increase to reach your 2030 target? Is it scale or a change in business mix? Does this require charter rates to increase from these levels to achieve this? So basically what we're looking at here is really that focus on operational excellence, and I've talked about the platform. So, the investments that we've made to support a growing business, yes, of course, there will be additional cost within that, but it wouldn't be at the rate that we can increase our revenue base. As the business grows, we have the technology, the infrastructure to support that growing business. As we buy individuals join us, or teams, or M&A comes on board, we can use that platform to support those businesses. Now, what that will do is that will then drive, as they come on board and our revenue goes up, then we can retain a good proportion of the profit there, and that will start to open up the jaws of the operational leverage in the business and improve our operating margins. Now, what we're saying, we're focused on building a more diverse and resilient business. So we are not, there is always going to be a shipping cycle, but as you've seen in these numbers and last year's numbers as well, it doesn't all move the same way. So we saw weaker tankers this year. We saw stronger S&P. Last year we saw stronger tankers. We saw slightly weaker S&P. The year before, stronger dry cargo. So you always get a mix of revenue, and that's why it's so important to be diversified across the shipping space, so you are not reliant on one single area of chartering or S&P or whatever it would be. The next question, in cutting the final dividend so substantially, what consideration was given to small private shareholders who rely on their dividend income? Do you want me to start with that?
Yeah, start with that.
Yeah, so look, obviously it's not a decision that was taken lightly. It was debated a lot at the board. We want to create shareholder value, and one of the ways you do that through an improving share price as well as paying dividends. We had a progressive dividend in place. We paid 5p in FY21. Now it went up to 13 pence in FY24. Share price hasn't really moved much to reflect that progressive dividend. I think the yield went from 3% to 6%. We believe that the yield now is an attractive yield, 3%. But given what we've outlined, we also, we've maintained shareholders' return. But given the opportunities that we've outlined, and I hope everyone's heard the opportunities that we've spoken about during this call, we believe that we can drive more medium to longer term shareholder value through investing that capital in the opportunities that we see, which will of course then drive longer term shareholder value.
Yeah, I think just to add to that, obviously the share price we feel has been undervalued to where the business is based, or where the business was some 4 years ago. What we've done, just want to emphasise the fact that I'm the largest shareholder within the business, and I too was thinking about the cutting dividends, but for me it's about growing the business, and the buyback seemed to be the best alternative option for us, and maintaining, as Grant mentioned, about the dividend policy and the percentage. So I think we've definitely looked at it very carefully before we made that decision.
Thank you, James. Next question. You mentioned regulatory pressure could create exits from some parts of the business. Could you suggest which ones? Just so we're clear, that's not our business. So there is ship broking is unregulated. Of course, we have a regulated securities business, so that's fully regulated in the jurisdictions that we operate in. But what we're saying is the unregulated ship broking business is becoming more towards a regulated business, and that's exactly why we've invested in compliance technology, etc., to ensure that when we're working with owners and charterers, they have the confidence that KYC, AML, all of these checks have been done. Now, if you look at smaller operators, that's an additional cost burden that they would have to bear. We have got that platform to support that, so we become attractive because they haven't got to invest in their business. They could become a team, or another business could become part of the BRAEMAR group and benefit from that platform that we have in place. So just to be clear, that wouldn't be us exiting parts of the business. It would be some types of our competitors or smaller businesses who would say, I want to become part of a bigger group because they've got that infrastructure in place and I haven't got to pay for it.
That's great, James, Grant. Thank you for addressing all those questions from investors today. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. But James, before redirecting investors to provide you with their feedback, which I know is particularly important to the company, could I please ask you for a few closing comments?
Yes, thank you once again for joining us today. We really appreciate it. And the most important thing for us to say is that we're pleased with the set of results this year. It proves the fact that business is resilient, and the fact that I think you can see we put a framework in place to build the business even further to the next 5 years. We've set some good, strong targets, and we believe that from the last 4 years of what we've done to where we're going, we feel we're well placed for that. And so thank you very much for that. And obviously, we were always there for additional questions to myself or to Grant. Happy to have that. Always happy to meet more and discuss further information if you need some more. But thank you once again for attending today. Really appreciate it.
Thank you very much.
That's great, James, Grant. Thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of BRAEMAR PLC, we would like to thank you for attending today's presentation, and good afternoon to you all.